Hey everybody, I wanted to talk about money market account money. All right. This money is changing very quickly right now. So when we look at what's going on, the first thing you need to know is we hit the all-time high in money market fund assets, and it hit $5.9 trillion on December 6th. That's 5.9 trillion with a T. But we're seeing them reduce that amount very quickly. And when we say they, who's that? Well, all of us average people that are sitting on tons of cash, we need to know that interest rates are starting to plummet. The Feds came out and alluded to the fact that they're going to lower interest rates in 2024. So you look at October, the left-hand side here is the S&P 500, and behind my head is the 10-year Treasury. Hit its all-time high at the end of October, and at the end of October, you saw the 10-year Treasury plummeting, as well as the stock market taking off. So there is a correlation. Where is this money going? Well, they're taking money out of these money market accounts as interest rates are pulling down. You might want to look at your money market account and see what the return is now, because most of them are pulling back interest rates. Instead of seeing in the fives, we're starting to see in the fours, and that is going to continue. So where do people put the money that they used to have sitting in these money market accounts? Well, first off, yes, people are putting it back in the stock market. And with lower interest rates, typically you're going to see categories like tech stocks do better. If we really do lower these interest rates, tech stocks do much better. Heavy borrowing in the tech stock world. The other side of this is people are trying to find ways to lock in fixed interest rates. We've seen record year after record year in these fixed annuity products. The fixed annuities are hitting $250 billion with a B this year, which is about 30% more than its other record years, right? So we're blowing away the records heading into these CDs from insurance companies. And there's really two types, but the one that saw the most growth is these multi-year guarantee annuities. These are not sold to you by anybody willingly. They pay a tiny little commission, and they don't get to take their management fee out of most of them. Some of them out there, they will allow it, so be careful, okay? They will give you a slightly higher, well, and I wouldn't even say that. Let's say a similar interest rate, but they're going to take a management fee out. We don't want those kind. They're not competitive out there. I'd rather have the kind where the insurance company pays the commission, not from your money. Makes a lot more sense. The problem is most of the advisors won't use them because it doesn't work into their business model very well. So just so we understand, we're trying to lock in these higher interest rates as long as possible. And as we sit here and right now in December, we're still seeing 6% from anywhere from 3 years to 10 years. You can still get 6%. Shows how flat the interest rates are. Most every insurance company is going to do a 5-year, a 7-year, and a 10-year. So understand the most popular I've seen there this year is the 10-year at 6%. Lock it in as long as you can. This is truly a CD from an insurance company. There are no fees in this. Okay, there shouldn't be any fees in this. If you're earning 6%, it should be compound daily. Okay, and just like having a bank account that's paying you 6% interest compound daily, they're just going to limit your access to the account so they can invest it to pay you that 6%. So they give you 10% access. Okay, this is usually, some of these companies allow you access to all the interest. Even if you didn't touch it for a few years, any interest growth in there, you're allowed to pull out. So there are some variations out there, but understand for the most part, tax deferred compound growth, 10% access annually. So you hit that anniversary, it refreshes. And consistently, we've always had higher interest rates than CDs in here. So just know these multi-year guarantee annuities are legitimately good, safe investments. And if you stack them up to any other fixed rate investment, whether it's bonds, whether it's CDs, you're going to pick these every single time. They've always been more consumer friendly. We just haven't needed them for the last 20 plus years because interest rates have been so low. There's just no reason to. But now we had this rise in interest rates, and now they're teetering, they're falling right now, and people are grabbing at this as fast as they can to lock in as much of these higher interest rates as possible. Because I think we all realize economically, it's very hard for us to push interest rates much higher than they are now. We see the banks starting to falter. We see a lot of problems out there. Surprisingly, real estate held on. It didn't get hurt as much as a lot of people thought. So just wanted to make sure everybody knew, the tech oriented, if we really do keep pushing these interest rates down, you're probably going to see a pretty good rise in the stock market, especially on the tech side. And grab as much of these fixed interest rates as you can. The safe investing hasn't looked better than this in 20, 30, even more than 20 years. So you're looking back in the 90s since you've seen interest rates like this. So lock them in as long as you can. That's the best advice you're going to get. You're going to want some safe investments typically. Lock them in as long as you can. All right, I hope that helps. Let me know if I can help in any way. 2024, we've got all of our full classes broadcast over Zoom. Make sure you visit our nonprofit website, fpfeaz.org. If you haven't subscribed to this channel, subscribe to our YouTube channel. We've got new videos coming out every single week. And keep an eye out for another website, yourinvestmentcounselor.com, which is the easy portal to get to me and schedule appointments anytime you like, yourinvestmentcounselor.com. All right. Hope all is well. See you next week. Have a good one.